incredibly important topic. So, welcome everyone. My name is Scott Whitehead. I'm the Chief Marketing Officer at Total Financial, and I'm really pleased to have our strategic partner with Highland Capital and Mike Raczkowski with us. I believe he's one of the latest additions to our friends at Highland, and we're super thrilled to be working with him. 2021 was an interesting year. There was a lot of things that went and didn't go from just a lot of areas, but from our world. I mean, I don't know how many webinars we hosted and how many things we hosted on all the changes that were going to come in the tax laws and the estate planning laws and all those things that went on throughout the year. And we pushed and pushed and pushed, and nothing really ended up getting done, unfortunately. But that's okay. But what I more importantly is, I think there's so many planning opportunities that came out of what didn't happen last year, and we need to discuss those planning opportunities because I think there is a lot of them, and that's what I think Mike's done a really good job of putting together some thoughts on where he sees some opportunities for 2022, and that's what we're going to discuss today. So with that, I'm just going to turn it over to Mike and let him roll. And if anybody has questions, everyone is muted, so if you could just put them in the chat box, I can grab them and ask them, and afterwards we can have an open mic session for questions if we have time.
Okay, sounds great. Thank you, Scott. Thank you, everybody, for joining me here this afternoon. So when I had started putting this all together and was working on building out these slides back in the fall of 2021, everything that I was putting in there was obviously based upon the narrative of this is what we think is going to happen with tax reform. And so I'll still have a little bit of the what we thinks and some conjecture in there. But also, I built this with a narrative in mind, which was that I think a lot of times when we, particularly as insurance professionals, we sort of skew towards the law of large numbers, and we start running everything based upon that, 1% or 1/4% who are going to gift away $12 million, and they're going to, establish a trust and set up a dynasty, and they're going to, and all of those sorts of moving parts for that very narrow sliver. And I think sometimes it becomes exclusionary to those people who are, maybe the next stage down, still very high net worth, or even getting into the mass affluent audience, where the fact of the matter is, if you have saved some money for the future, or if you have a good income, you should be concerned that the planning you should be concerned enough to take advantage of planning opportunities that exist today, because it's my theory, and I think I'm going to build the case with the data that I'm going to present, that ultimately you need to take advantage of those planning opportunities while they exist, because I don't think they're going to exist forever. And I frequently find myself saying it's not paranoia if they really are after you. But when you look at the overall, the financial picture and kind of the macroeconomic environment, I think I'll build a strong case that all of our clients really need to be doing their planning and taking advantage of the tax opportunities that exist. Whether that's, simple gifting to a trust to have some dollars insulated outside of your taxable estate, or if it's planning with annuities, or if it's planning with Roth, or whatever their solutions are, people need to take advantage of it. So I should tell you, when I started putting this together, though, about the ups and downs of planning, I'm a sports guy. And so I go from, during the football season, I dream of baseball season. And then during the baseball season, when my team isn't doing well, I dream of the football season. So it gives me a nice rotation throughout the year. And so, of course, when I started putting this together, football season was still going. So I immediately gravitated towards baseball, because I felt like my team is tied for division lead right now, and I shouldn't be, nobody can be upset about how they're doing in baseball. So I encountered this old quote from Satchel Paige: you win a few, you lose a few, some get rained out, but you've got to dress for all of them. And I think that's a good summary of what we're seeing from a planning standpoint, is that I think where the market is going to be and where it's going to go, there's going to be some wins there, there's going to be some losses there, and there's somewhere, it's going to be a rain out, and we have to kind of either reschedule or at least withhold judgment for a while until somewhere down the road. So when we look at it, what's going to be on the field for 2022, and in particular, where do I think we're going to see the good opportunities, and where do I think that we see the future negatives that we may want to plan and kind of encounter accordingly? So starting with the scouting report, the things that I think are going to be, we're going to call them the home team, but the good guys, the favorable items, going to be tax deferral. I think that's going to continue as an environment where we're entering into what seems like it's going to be a higher tax rate in the environment in the future, or at the very least, a case where there is going to continue to be that push for increased revenue for the federal government. We certainly have to consider the power of tax deferral and how that's going to work for your clients. Tax-free death benefits, leverage, lifetime or future income. So building in some of those pay raises in retirement for clients, I think that's going to be critical. Long-term care benefits, making sure they're keeping up with what the client's needs are going to be. And then one thing we should watch for that is really flying under the radar screen, I'll talk about in a few moments, is Secure Act 2.0. Now, as for the visiting team or the unwelcome visitors here, we should look at what's happening with debt, future tax increases to fund spending, since it seems like the idea of bringing spending in line with revenues doesn't really seem like that enters into anybody's consideration anymore. So inflation, loss of buying power, and then lastly, interest rates and where they're at in kind of a downward channel. So when we consider all of this, I took a variation of, we've all seen this kind of a slide over the years in the industry, where the tax rates are and the top marginal tax rate over the last 40 years. But a lot of times you see this and they'll show the chart going back to 1913. And the problem with that is that I think you really have to consider the evolution of the modern tax regime really started with Ronald Reagan's election in 1981. You could make the argument that it began in the late 60s with the development of the AMT, but I'm going to kind of bring us to just the last 40 years. And so everything that they've talked about in the last year plus with tax increases and everything was really related upon moving this line up ever so slightly. And if you look at this line over the last 30 plus years, it's really not even an EKG. I mean, if you send this in with an underwriting file, they're going to get a nice decline letter. So it's barely moving and the pulse is barely moving. But the part that is moving is this is just the overlaid against the federal debt outstanding at the end of each and every year right through 2021. This is actually already outdated because we're already just a whisker over 30. And a trillion here, a trillion there, sooner or later, we're talking about real money. So I'm sure you can all see with pinpoint accuracy right in here at the late 90s when we had that famous Bill Clinton surplus and that 1 year where we actually had a budgetary surplus, right? Really made a big difference, didn't it? So 70% of our current US debt has been created in the last 14 years. And it's on a path to continue like this really to the horizon. We face the demographic challenges of an aging economy and aging workforce, the looming exhaustion of the Medicare Trust Fund in 2025, the Social Security Trust Fund in 2033. And more years with higher inflation will move the dates of those up as cost of living increases are added to increase expenditures on current beneficiaries. So in short, the fiscal outlook is not good. Now, if you add in the politics, because it's a little hard to do this sort of a macroeconomic environment without touching a little bit upon the politics of it. And if you add the politics that the Federal Reserve is dealing with, it is less favorable. In 1981, President Reagan was united with Donald Regan, who was the Secretary of the Treasury at the time, and Paul Volcker, the chairman of the Federal Reserve. And they all united with everybody going in the same direction. The direction was increasing interest rates to dry up excess monetary supply to tame inflation. Now, they did all of that knowing it was likely to trigger a recession. So I sometimes describe it as sort of a chemotherapy kind of approach. You basically made the patient sick in order to make the patient well. So they did this. While they did that, they also were, as I said, they were united and they kind of knew they were taking their poison for 1982 and 83 and ended up with 1984, the morning again in the America election. But with all of that, where we're at right now, we're already facing what's likely to be a challenging midterm election for Democrats. The president's domestic agenda appears stalled in Congress right now. And the Secretary of the Treasury and Powell at the Fed are certainly more dovish than we would have expected, which means that there isn't that consensus amongst those top three parties to sort of absorb the short-term fix of making the patient sick to make the patient well. So as such, if they really do take the steps that are outlined about raising the Fed funds rate, and particularly they're talking about 4, 5, 6 increases in the next year, I think that's overstating it. I don't think that's likely. But either way, I think they're going to be concerned that if they have to do it at real short notice because the numbers are looking really unfavorable on inflation, that will spook markets. And they also are going to be concerned about doing it too close to the election. And then they're also going to be, so that leaves kind of 2023 and 2025, because 2024, they're going to want to play it safe and not look like they're putting a thumb on the scale one way or the other for the presidential election. So what it really comes down to, if we look at all of that, is, that seems like that's a different environment than what we were dealing with the last time that inflation was this high. One other political thought is that the older population has probably got more exposure to equity risk than previous generations would have at the same age, partly because of, they want to keep their portfolio up and performing, and the market has obviously been very favorable, and partly because of TINA. There is no alternative. Where else are you going to go to get yield right now? As a result of the Fed decisions to keep the interest rates as low as they have for as long as they have, that's created a risk-on concern that the Fed is going to make possibly more dovish behavior because of that. Well, let's face it, they don't want to cause a major market correction or recession when millions of the most active voting bloc in the country are overly exposed to equities because the Fed drove interest rates to zero and left them there. So, well, of course, it's going to get better in the 20s, right? So I updated this chart to just project the next 10 years worth of the deficit spending on the base, and I added the numbers for the bipartisan infrastructure bill signed into law in October. So as you can see, by 2031, shortly before the Social Security exhaustion over here, we're going to be at 42, something like that. As I said, sooner or later, we're talking about real money. But inflation, if we're looking at it, a lot of the comparisons that are being made with inflation right now, we're really focusing on, this little blip here that we had in 2021, and you can compare it to sort of some other temporarily inflationary periods, like coming in 2009 and 10. We actually had a similar inflation profile, but because we were coming out of the deflationary environment of the financial crisis, people didn't really notice. It didn't hurt, right? Whereas if you really go back and you could look at maybe 1988, you had again another burst there, and then you go back to the 70s. And 1971, some important stuff happened. So Stairway to Heaven was released by the greatest rock band ever. The famous Vulcan proverb, "Only Nixon could go to China," appeared in print for the first time. And inflation temporarily dipped below 5% before climbing above 5% for the next decade. So if you look at 1971 and you think about who was at the Federal Reserve at that time making the decisions and trying to influence and improve policy to contain inflation, well, they're all dead. So there's just nobody left there. So as a result, when we look at the chart and we have to kind of consider, where are we in this cycle? Are we here in 71, or are we at this time period in 2009 or 10? Well, I think if we can't necessarily accurately gauge where we're at on all of that, but we are to a certain degree in a situation without precedent. So what we need to consider, though, from a client's perspective, is at 4% inflation, you need to double your income every 18 years to keep up with inflation. Or another way of putting it is, at 4% inflation, every 9 years, you need to increase your income by 50%. When you start putting it in those terms for clients, they're going to start feeling that sting. At 5%, it's every 14 and a half years. At 6%, it's every 12. So the implications for this for retirees and near retirees strikes me as, I think it'll be very bullish for the annuity marketplace. I'll keep building the case for that as we go along, but I think that's something where, building in pay increases for clients using deferred income annuities and solutions like that, or enhanced performance and higher rates of return versus their safe money, I think that's going to add extra value in someone's financial plan, particularly with the options that exist for sideline money. And I'll talk more about sideline money in a moment. But even prior to this outbreak of inflation, when inflation was tame, we should realize that over the course of 20 years, inflation still turned $1 into 63 cents or 67 cents, let's say. So just starting right up here, and this is from the St. Louis Fed. But if you take a look here, you can see how inflation, starting in 2001, drove the value of your purchasing power all the way down, so that here it would have been about 67 cents by the start of the outbreak of COVID. Okay, so just as we spoke a moment ago about how annuities may be used to shore up someone's financial plan for their retirement years, we should just look at the erosion of buying power, because this also requires us as financial professionals to revisit some of our clients, talk to them about that $1 million policy that they bought 10 or 20 years ago and how it's lost substantial buying power, and thus the ability to preserve capital for the beneficiaries over just the last 20 years of stable or tame inflation. So I'll make a case momentarily for how we revisit those cases. But first, I like to see this slide kind of going the opposite direction. So if we consider it the other way, we could just take $1,000 of buying power in 2001, and then we can elevate that and see where it was. And by October of 2021, you would have needed almost $1,600 to equal the same buying power that you had in January of 2001. So while inflation is described as a stealth tax, it has been largely stable since the 80s. Milton Friedman described it, the Nobel Prize winning economist, as always and everywhere a monetary phenomenon, by which he meant too much printing equals inflation, okay? So another way of taking a look at it is this is the M2 money supply. The M2 money supply is the sum total of all cash, savings accounts, money markets, CDs under $500,000, checking accounts that people have on deposit at banks. And during the history of the US, 75% of the entire US money supply has been added in just the last 14 years. Does that coincide with the reemergence of inflation, which obviously has been the hot topic for the last 2 years in the economics press, or whether it directly impacts it, or whether it's been more of a demand-driven shock, which I think is what the Fed is still arguing, with supply chain disruptions and things like that? I think all of that remains to be seen. But regardless, it's reinforcing a narrative that has taken hold and taken root in the client's mind. And that narrative is that the Fed is indiscriminately printing money. And the internet has even made memes about it where they refer to the printer going brrr. Or again, going back to Milton Friedman, he said only government has the power to take perfectly good paper, cover it in perfectly good ink, and make the combination worthless. So interest rates are going to be better though, right? Because the Fed's talking about the Fed funds rate going up. Well, the good news is where interest rates have been has managed to keep the interest expense in the federal budget relatively tame as part of the overall federal budget. But the Congressional Budget Office, the 10-year projection of interest rates shows the interest rates going from 1.7 in 2001 to 1.4 in 2022 and 2023, and then normalizing as high as 2.7 by 2031. Normalizing at 2.7 would be essentially a doubling of the interest expense on the federal budget. And going back to that chart from the beginning. So the drawback to where interest rates are is that if you notice, they really have been in a remarkably stable channel where even going up, this is charting the 10-year treasury since 1986. So even seeing when it's had peaks within there, it's had lower highs and higher lows all these times. Or excuse me, lower highs and lower lows all this time. So it has been going in one direction. The channel has been going down. The Treasury is hands down the largest securities market in the entire world. And so in order to break it out of this particular channel, I believe that will cause significant damage to the economy. And in particular, short term, short recessionary kind of terms. Okay, and so I think that would be, by being damaging to the economy, we have to kind of almost look at it as, because it's been in such a straight, consistent line, it's sort of like that scene in Titanic where they try and turn around the iceberg. It's hard to turn something that large, whether the ship or the 10-year treasury, and it's hard to turn it that quickly. And so as a result, it's kind of one of those where I think the metaphor works, because frankly, they would have lived if they had just crunched straight into it, and instead they hit it with their side. And we've all remembered, we've seen the movie. As such, we should kind of plan that interest rates are probably going to continue to stay in this channel. And if you notice, they had gotten quite a bit of, just a tick above 2% there. So they were starting to get here a little close. And then they've all of a sudden had quite a bit of relief in just the last week where they've gone the other direction. Buyers have poured into treasuries to drive up the price of treasuries and drive down the yield because of the things going on in Europe. So all of this, I think, can create some good opportunities for planning. And so we'll get to some of the advanced planning opportunities with that in just a moment, but it's something to kind of all of us keep in mind. Overall, though, if we just take the macroeconomic environment for 2022, we have, from a 10,000 foot overview, we have low interest rates, higher inflation, huge stock market gains recorded by our ideal clients, the mass affluent, high net worth, ultra high net worth individuals, a market where you can offer better alternatives and better rates of return for safe or sideline money using, for example, life insurance, linked benefits, annuities, all those solutions than the clients are getting right now. A market where you can look at building in pay raises for clients in retirement, because remember, they're going to be worried about that first, their immediate portion of their pocketbook or their balance sheet that impacts their day-to-day living and expenditures. So anything where you can help shore that up will free up additional capital that can be used for other planning opportunities. And this is also at a time when, by maybe redeploying or taking some of the profits off the table with regards to their stock market gains, or right now, maybe they're offsetting some gains with some losses based on how the market has started the year. All of that, I think, can give clients opportunities to buy millions of dollars of life insurance, particularly trust-owned life insurance, as a protective put against the value of their portfolio, often now by using no-touch accelerated underwriting. And lastly, this is a market where keeping your sideline money, we need to emphasize this to our clients, sideline money is losing 6% or more in 1 year to inflation, and that is probably more exposure to risk than clients would take if those same clients were allocating to equities. So I think we need to remember the solutions that we have for things like that. Now, going back to my baseball metaphor from the beginning, there's a famous baseball story about the old pitcher from the 70s, Gaylord Perry. He was known to on occasion throw the illegal spitball. And after one of the games, his daughter, his 5-year-old daughter, happens to be in the locker room, and a sports reporter asks her about her dad throwing a spitball, and she replied, "It's a hard slider." And I kind of love that little girl because that's just a great story, first of all. But these are the hard sliders. If we want to not say that they're spitballs, we'll say that the hard sliders that Washington talked about in 2021. Okay, so recognition of unrealized gain on unrealized capital gains for applicable taxpayers. That was the Billionaire Tax Bill that the Senate introduced. Closing down the backdoor Roth IRA. And I'm going to define the backdoor Roth IRA just so that we're all kind of consistent with what I'm talking about there. A backdoor Roth IRA is where someone makes too much money to contribute to a Roth IRA, but they don't make too much money to contribute to a non-deductible IRA. So if you do contribute to a non-deductible IRA, you can then convert because there's no income limitation on Roth conversions. So you can put it at $6,000 into a non-deductible IRA, doesn't save you on your taxes, but then you can convert it to a Roth IRA and you don't have to pay any taxes on that because your same $6,000 that you already paid taxes on is moving right over into the Roth. Congress doesn't like that because that doesn't generate any revenue for them right now. So they're going to shut that down. RMDs on mega-sized IRAs, by which I mean $10 million and above, trust tax increases, income tax surtaxes, or income tax increases. They want to call it a surtax and basically, add new tax brackets at extremely high income levels. But essentially, those are just huge tax brackets starting at with a 5% and then an additional 3% surtax at 10 and 25 million. So that'll hit your clients who do that once in a lifetime as sort of a sale of property or a business. Repeal of step up in basis. That one seems dead, but it was a proposal that they threw out there. So I do feel I should mention it in the spirit of disclosure. The expansion of the 3.8% net investment income tax. Out of all of these provisions here, that's the one that they really proposed that will probably capture the most people. And so they would start by expanding that to include wage and business income, particularly for pass-through entities starting at 400 to 450 married filing joint. So that's one of those where, successful small business owner who's earning a good living, but not, crazy living. That's going to be one of those where that's going to start to capture them early. Changing the grantor trust rules. Again, that one seems like one where they just don't have the votes. Corporate tax increases, they may be able to cobble together the votes for that one. And then lastly, the early sunset of the estate and gift tax exemptions. So the play at the plate. There's an old Babe Ruth line where he said, yesterday's home runs don't win today's games. Although I would argue with a lot of our existing clients, they could very well win today's games. So if we look at, what's happening here, the good news is Secure Act 2.0 is working its way quietly through committee in Congress right now. Nothing on this is probably going to happen until at least I would say May or June, possibly even later in the year. And it's not probably going to turn into a 2022 sales opportunity, but it could be this stuff for 2023. So the reason I think this is likely to pass, number one, the first Secure Act passed with about 65% of Congress voting in favor of it. So it's very bipartisan, broad support for it. So, second of all, this kind of enhances the theme of Congress pushing people for more retirement readiness. And then lastly is this is being debated in committee and talked about in committee. It is not being debated on the front page of the newspapers. As soon as they start debating the big provisions on the front page of the newspapers, partisan rancor enters into it and nobody wants to agree on anything. So the broad strokes of what they've already kind of at least laid out inside of committee, and remember, Schoolhouse Rock, this is just a bill right now, but would increase the RMD age to 75, eliminate RMDs for people with less than 100,000 in retirement savings, encourage income annuity ownership, in particularly inside of qualified plans, and then make qualified longevity annuity contracts more appealing. All of these could really be, in particular, by overcoming some of the what if I use it or pay for it and I never use it sort of a scenario, by allowing benefits to get shared between spouses and scenarios like that. So all of these are going to be situations where it's going to continue to encourage retirement readiness, but also it's going to allow people to leave their qualified plans alone for longer. And that means that if they have a really robust qualified plan balance, they may start saying, maybe I need to redeploy some of that capital, use qualified plan maximization, take some of the money out, use that to fund life insurance or set up, some of my other planning objectives. So all of that, I think, is going to really be a tailwind for the financial planning industry. So I think these will be positive. For the long ball, some of our other solutions here, you should really look at calling up previous cases. High net worth clients, go through your book of business and triage situations where they may be able to qualify for more coverage with accelerated underwriting. Particularly, they've seen significant gains in their balance sheet in the last couple of years. So even though it might be down a little bit from the high water mark at the end of December, still one of those things where it's been very favorable for them. So is their current coverage sufficient? Are the baseline assumptions you made about how their estate was going to grow? Well, if their estate did this over the last 2 years, are those baseline assumptions, are they worried about estate taxes now? Are they exposed to estate taxes more than they were? And then, certainly look at situations where large cases funded with gifts or where gifting was maxed out. We've all run into that client who already gifted away their $12 million or 11.7 last year. Well, maybe they have additional gifting capacity available now. They could take advantage of some of that as well. Remember, the gifting, even just annual gift tax exclusion, is significantly increased from where it was 5 years ago. And 10 years ago, it was still only 13,000. So the 16,000 per year now, per donor, per recipient, that could all of a sudden, if you're stacking several of those gifts together to fund life insurance and trust, that could easily free up another $10,000, $15,000, $20,000 worth of premium on those stacked gifts. So all of that, I think, is going to be very favorable. Also, let's look at getting players off the bench. 266 years and 8 months. So if we go back 266 years, George Washington was like 20 years old. Okay, so that gives you an idea of how long ago we're talking. But using the rule of 72, that's how long it would take you to double your money using Bankrate.com's December rate report of 5-year jumbo CDs, which were 27 basis points. Okay, so with CPI increasing, call it 7% in 2021, your clients who have large cash positions lost themselves, 6 or more % in real terms in buying power. So multi-year guaranteed annuities, indexed annuities, life-linked benefits, single premiums, where you just reposition for a better rate of return and look at the IRR at pre-tax equivalent IRR at death or at death plus 5 years. All of those sorts of scenarios where you can start projecting out. At the very least, it's not an idle asset on their balance sheet, and it's not something that's kind of losing on them all the time as well. So another way of looking at this, because the Federal Reserve put out a nice report where you can actually get it online, of the 12-month prevailing rate on non-jumbo 100 and less CDs, it's basically 14 basis points. So, at that point, you're paying taxes on that 14 basis point on your $100,000 CD, and what are you really gaining for it? Well, you're losing about 6% in actual buying power. So think of those clients who bought a $1 million policy back in 2011, okay? Due to the impact of inflation, they would have to have bought a $1.221 million policy to have the same purchasing power in 2021. Now it's probably a 1.230 or 1.25, so revisiting those larger cases where additional gifting capacity may be available, the $360,000 increase in lifetime exemption. Also use the math of that $360,000 exemption in 2021. Use it to your advantage, okay? Because it was 11.7 last year. Inflation went up 7%. So how much did the unified credit or the estate tax exemption increase? About 3%, because only in Washington does that math make sense, right? So for your clients who are going to, they're seeing their estate do this at maybe a little bit of a faster clip than they had been previously, they should remember the exemption seems to somehow be going up at half as fast, even though it's supposed to be indexed to inflation. And then also watch the annual gift tax exclusion, because that 13,000, from 09 to 12, those cases that you sold back then, there might be enough additional capacity now with adding up to 16 that, you know, it can make a difference of adding another $1 million in survivorship, or I add another $500,000 in survivorship for those cases. So that brings up, you know, of course, we all knew the slaughter rule when we played Little League. It was when you kind of got too many runs ahead, they either called the game early or they just stopped keeping score. But other options for inflation protection that may be appealing to clients, you know, sometimes we still see people, when we still sell a fair amount of the whole life coverage with, you know, participating whole life carriers, because clients like that paid up additions because it goes up a little bit each year. They like the perception that it's keeping up. So option 2 death benefit designs, return of premium designs. We're seeing a fair amount on the accumulation side of max funded minimum death benefits, so it can really do that as well. Look at your linked benefit and long-term care rider cases. A lot of times you sold somebody a Money Guard or a Nationwide's Care Matters or Secure Care, or any of those products. You might have sold them, you know, 5 or 10 years ago, and it was a good benefit. But when you look at the numbers now, maybe the numbers don't feel quite as comfortable for that client. Might be worth revisiting and seeing if you could supplement or add additional coverage. Same thing with, you know, cases where you've sold existing annuities, looking at adding additional coverage there. Deferred income annuities, you know, for the longevity discussion to build in future pay raises. And then I've talked a lot about diversification, you know, amongst different asset classes, because I do think there's sort of a mosaic where they all work together: life insurance and annuities and your qualified plans and your managed money and all of these things. Okay, so client portfolios have had some good years. Why not? Why stay exposed to that level of risk, particularly as you're getting older? And there's a question of whether the market is going to perform as well for the next 10 years as it has for the last. I've already started seeing the news articles hitting on Barron's and Bloomberg of, you know, well, are we going to be in a period of, say, 68 to 80 where the market basically went nowhere for a dozen years? Or are we going to keep doing what we're doing? We can't really say. I think realistically, it's probably somewhere in between. And the reason I think that is that it's a much more global economy than particularly the stock markets than they were back then. So, you know, I think likely a lot of the big players in the US market will continue to hold up because they're still growing their marketplace with Apple in Europe or South America or Asia or Africa or anywhere. So looking at all of that, I do think that it's, you know, likely to continue to go up in the general terms, but taking some of that off the table and just taking a little risk off the table for the clients and using life insurance or annuity death benefits to kind of protect the value of their portfolio, or looking at assets that are producing current taxation and move them to something with tax deferral, like I talked about back at the beginning. And then when you revisit existing cases, I think you can also uncover new sales opportunities. So consider something like this, where somebody did a private financing or a sale to a grantor trust a few years ago, just in June of 2019. It's not even 3 years ago now. Well, the long-term AFR then was 2.76. So if an asset generates 6% free cash, the grantor would basically have to pay $138,000 in loan costs each year, and $162,000 balance would stay to pay the lifetime premium on a life insurance policy inside of that trust. Well, what if we could refinance that note, bring it down to, say, 1.86 was the November rate. So we're kind of at the outer edge of being able to use that. So now we'll probably have to use the December at 1.94. But you can certainly use any one within the last 90 days you can use for the refinancing of the note. But you could refinance that, and you look at lowering those loan interest payments. So instead of the grantor getting 138 back from his trust each year, he gets 93 back. And that frees up an additional $45,000 available for premiums to buy additional coverage without putting more money out of their pocket. It's just making the transaction more efficient for them. So when we consider what that batting order is going to be for advanced planning here in 2022, revisiting cases, private financing, look at, can you rewrite the note? Can you use that, take advantage of the AFR that way? Premium financing, we're still seeing a lot of movement in that direction because people still feel the cost of capital is lower than their acquisition cost. So the arbitrage is still really positive. Split dollar, I think that's going to have a real heyday and a real comeback, particularly when the estate tax exemption drops in the future, which is scheduled for 2026. I think it's likely because if we consider all of those macroeconomic details I sort of explained at the beginning, my operating thesis is that the federal balance sheet is just going to continue to be ugly. And at some point, they're not going to have any choice but to come from more broad-based, widespread tax increases to keep the spending taps going. Obviously, they just don't seem like they're considering, neither party seems like they really consider austerity or spending controls. They're just going to let the spending go on autopilot and try and bring up the revenue at some stage. So additional gifting, inflation concerns, all of those are going to be real positives. In the business planning market, non-qualified deferred comp, executive benefits, options where clients might have the flexibility of sort of controlling when they're going to report their taxable income in the future. I think that's going to be a real positive. So, continue that to be another one of those places where, it's likely that the market is going to go over the next couple of years. Key person, for the business owner, a lot of times I'm seeing that case now where it's sold as a key person. The business will own it, be the beneficiary, be the premium payer. And then at some stage in the future, the business will plan on distributing it to that employee as a kind of a reward and a retention tool. 5 years out, maybe 10. I really don't see a lot more than 5, because I don't know that there's enough of an incentive there from the perspective of the employee to tie them there for 10 years, but some sort of golden handcuff arrangement. And then with a retirement plan, 401k advisors, annuities being used in there, like lifetime income, they're definitely getting a tailwind, and Washington is pushing solutions like that. They like it because it kind of creates almost like a pension for people. And that's at a time when all the pension systems are sort of under a lot of pressure. Other areas where you'll continue to see, some solutions. Well, the 2022 lineup, I think, is going to have LERP sales to replace the backdoor Roth. So illustrate $6,000 per spouse on an accumulation product, or maybe if one spouse is healthy and one is not, use $12,000 for that one. Look at longevity planning with annuities, income, LTC planning. And then lastly, let's not lose sight of trying to reposition and get those cash and idle assets off the sidelines, get them into the game, because they're just not doing enough for people when they're sitting there. And at 6.8% inflation in 2021, those idle assets, CDs, savings accounts, money market, checking accounts, they lost a lot of money in real terms. Offer a real alternative to your clients. So I know there is a lot there. And the only thing I wanted to conclude with, because it's changed since I put all these slides through compliance, is the legislative calendar. There's been a lot of discussion right around the turn of the year that we were going to see, they were going to put together Build Back Better, and they were going to push it out and try and get something done by, early here in 2022. So far, it doesn't seem inclined that that's happening. And, Joe Manchin obviously kind of put the nail in it back in December. I feel like that's probably fairly final, but we have the beginning of March. I think next week actually is the first of the primaries for Congress. That's going to be in Texas. And then starting almost every week through the end of June, there'll be 1 or 2 states having another primary. So you can see where that's going to start, sucking up a lot of the oxygen in Washington, because anybody who's running for re-election, I mean, let's face it, if you're an elected official, your only job is to watch out for number 1 and don't step in number 2. Most of them fail at 1 or 2 of those, okay? But when we look at it, they're already going to be pushing to try and get themselves out of Washington and for the legislative calendar to get out there and start campaigning, get on the campaign trail for primaries, and then, of course, for the general election in the fall. Well, then, of course, we ended up with that scenario where kind of a worst case scenario where you get the Supreme Court vacancy right there getting into that time. And that's going to suck up all the oxygen in Washington. So that's going to put any sort of tax increases on the back burner, okay? Then you had Senator Ben Ray Lujan from New Mexico, who's a 49-year-old Democrat. He had a stroke a couple of weeks ago at the end of January, beginning of February. Had surgery. He's going to fully recover, so we're all glad for that. But that also puts him on the shelf for 6 to 8 weeks. So he's not going to be available to vote on anything until probably mid-March, maybe a little later. What's going to happen, though, is they're going to continue with Supreme Court hearings. They're going to do all of that. They can't hold a final vote until he's available, because I don't care how bipartisan you are. If you are Mitt Romney or Susan Collins from Maine or Lisa Murkowski from Alaska or one of the kind of the very moderate Republicans, you are not going to provide the 50th vote. You'll provide the 51st, maybe. You'll provide the 52nd, definitely. You're not providing the 50th. So that's going to slow all of that down. And none of them are going to cross the aisle to support the big tax increases that the president's agenda is talking about. So all of that seems like it's stalled. Probably nothing is going to happen for the next, couple of months on anything tax related. If anything does start to happen, I could see a scenario where mid-year or even possibly end of year right after or around the time of the election, you end up with SALT relief. That seems to be the only part where the party has really got, I think they've got the votes to do some sort of SALT relief. SALT is state and local tax relief. Now, you lucky folks who live in like New Hampshire, where you have no income taxes up there, you don't probably have to worry about that much. But the unfortunates who are in, say, I'm just going to pick one off of the map, California, where your taxes are fairly high, you want that, because the way the SALT deduction work is you're capped at $10,000 of state and local taxes can be deducted against your federal taxes. And prior to 2017, it was unlimited. So that was kind of to be honest, that was kind of like the first tax increase we've ever seen Republicans vote for in our lifetimes. So they should, I kind of feel like it would be a little foolhardy to start trying to pull the rug out from under that one and kind of make it into a political hot potato. But remember, overwhelmingly, the blue states tend to have higher taxes. And so therefore they have more leadership in Congress as well. And so as a result, they're really feeling from their constituents the pressure to try and get some SALT relief. So I still think there is a possibility that some of those items that I detailed in the slide with all the baseballs, some of those end up at some stage cobbled together. Grab this one, grab this one, grab this one as revenue raising activities, so that the SALT deduction will be a revenue loss, but kind of washes up. So either way, if we try and look at where the rest of 2022 is going, I think that's probably about the end of it, and kind of the last thing that we're going to see. So I know there was a lot there. I'm going to pause, take a sip of my drink, open it up for any questions or anything that we can answer on that.
Wow, that was a lot of info, Mike. All right, who's got questions? I'm going to play the cricket sound here in a moment, but
or you could do the Jeopardy theme.
I could. Nobody wants to hear me sing. That's never a good thing.
Yeah, I get that. I get that a
lot. You'll make this PowerPoint available for us, won't you, Mike?
Certainly. Yeah, I can send it right over to you.
Okay, that would be great. So if anybody wants that, my email is swhitehead@totalfinancial.com, and shoot me an email. I'll send it out to everyone. So if there's no questions, first and foremost, thank you, Mike. That was an incredible amount of information, but I think it's really relevant. I mean, I love what you said about, go back and revisiting. It goes back to one of the things that I always talk about is policy review, right? But in this case, there's a real reason to go back and say, hey, you bought a $5 million policy. You might need to be looking at 5.5. Let's grab another $500,000.
And especially with accelerated underwriting, you can very often pick some of that up now with, in such an easy fashion compared to what it was, 5 or 10 years ago, and with so many more opportunities,
Yep. And with some of our new tools, with Vive and with IXN and some of our new submission tools, it makes it so much easier to write that piece of business. And then on the annuity side, you got to get that cash off the sidelines. And we've got a full lineup of, MYGA, SPIAs, index annuities that, we could chat about. And our partners at Highland actually help us do that. So Chris is always available to help you for annuity planning. So if there's no questions, I'm going to say thanks to everyone on the phone here, and thank you to Mike. And I know there's a lot of people that are coming to my sales university in a couple of weeks here, so I'm looking forward to seeing all these faces in person. So with that, thank you everyone, and have a great day.
All right, you too. Thanks for having me.
Thank you.